Welcome to the Cashflow Playbook, Unlock Unlimited Growth. And my name is Kyle Hunt, and I'd like to start off this presentation with a very simple question. What is your most important financial KPI as a DTC brand? And I'll give you a second to think about it. And a lot of the times I hear profit, or I'll hear gross margin, but the answer is actually cash flow, right? And this is a presentation on cash flow, so you might have guessed that. And as we go through this presentation, it's going to be difficult to have an open mind because most people don't believe this. And they're going to be challenging ideas that might not make sense to you. And they might even really bore you because most people don't find finance that exciting. But I want to really change your mind around cash flow because cash flow is the most important financial KPI for any D2C brand. And there are many instances that I would say it's even more important than profit, which sounds like heresy, I know. But without cash flow, you can't pay your bills, and you can't survive even if you're profitable. And the mistake that most D2C brands make is they try to save 5% on inventory costs by doubling their inventory purchase sizes, when really what they should have done is use that cash flow more effectively and more efficiently. And I'm going to walk you through how we fund our own brands here at Weekends, and also how we advise our clients to fund theirs as well. So we look at D2C brand spend in three main buckets that you can see here. We have inventory, we have ads, and we have others. And really our goal is to get net terms on everything. And this allows other people to finance our business so that we have more cash in our bank so we can invest in new products, we can invest in new assets, maybe new people, or God forbid, take a distribution every once in a while. And I'm going to highlight each one of these here and get more into detail later in the presentation on each one of these as well. So inventory is going to be our first main bucket. And most people start this off the wrong way because they don't try to collect funds from customers prior to a new product launch, which I'm going to explain later. But we always want to try to get something prior to a launch. And then we want to negotiate with our suppliers. And the goal here is getting net 90 terms. It doesn't always work that way initially, but this is our long-term goal. And then we want to use invoice financing if our margins can support it. That's not always the case, but if we have great margins, this is a really inexpensive way for us to get some additional cash flow in the business and potentially a line of credit, which I'll talk about later. And this is going to extend our terms to net 210 to net 240. And what that means is you're going to sell your inventory before you even pay for it, right? So our manufacturers are financing our business in this case, or invoice financing company. Ads is going to be the second main bucket that we're going to attack here. And we really want to get on net 30 terms with all the platforms. And then after that, use invoice financing to get net 90 to net 120 terms if that's available to us. And this is going to get us to net 120 to net 150. And again, this means we're paying for ads after we've already sold stuff, right? So Facebook or TikTok is financing our business at this point. And lastly, we want to put everything else that we can on some sort of net 60 card. And I'll tell you about these because these are very controversial. And we can also do some really cool stuff with these cards. So I'm going to walk you through the following ways to help with your cash flow, starting with the lowest risk options up here that are in green. And these are low to no risk. These are lower interest rates. These are going to be much better for your company and where you're going to want to start in this process. And then move to the higher risk options that are going to have higher interest rates. They might require collateral and are typically going to be your lenders of last resort. And the intent of this is really that you start up here at the top and work your way down. So we're going to cover suppliers, customers, ad platforms, banking platforms, credit cards, line of credit, invoice financing, inventory financing, PO financing, and revenue-based financing. And this is a typical cash flow stack. There might be a couple other things that I left out, but this is going to be the majority of what we're looking at from a cash flow funding perspective. All right, so let's start off with our suppliers. And our suppliers are going to be the quickest and the least expensive way, really, to help fund cash flow for us. So there's four areas here that I want to cover. And the first one is negotiating with our suppliers. And really, as I mentioned in the first slides, your goal is to get to net 90 terms. And we're going to do this in a couple different ways in 3 steps. So number one, we want to ask them. Most people don't even get to that point. They just assume, right? So we want to ask them. We want to paint the vision for them and kind of show them how this will help you grow, and then an extension them grow over the long term as partners. And then you're going to want to give them some sort of carrot. So ask maybe like, what would get you excited about giving us net terms on this? And maybe the answer is some sort of interest rate, right? And maybe you're going to have to start off small and you're going to start with net 14 and then you'll go to net 28. But you really want to try to regularly extend these terms in some sort of 14 to 30-day increments. The key to this is doing this without increasing your order size so you can conserve cash. So most people will say, well, what if I just double our order volume? Will you give me better terms? And that might give you a little bit better terms and it might give you a better price. What it's going to do is deplete your cash. And the whole reason we're going through this training is so we can keep cash in our bank accounts so we can use it to invest in our company, right? So don't do that. The second item here is increase your inventory turns, have faster inventory turns. What this means is if your inventory turns every 3 months, which is 4 times a year, and that's pretty typical for most of the DTC brands that we're auditing, you're going to have double the inventory on your balance sheet than if you were to turn your inventory 8 times per year, right? If you turn 4 times per year, you'll have double the inventory as opposed to if you turn 8 times a year. And you really want to turn this inventory into cash in your bank because right now it's sitting on your balance sheet. You can't use it. It's inventory. So what I'm essentially advising you here is that you're going to do more frequent but smaller inventory buys. And this might actually cost you more per unit. It might cost more per shipping, whatever. But remember the paradigm shift that we had earlier, where cash flow is more important than profit to some extent, right? But as long as that price increase is not substantial, and I would say substantial would be like a 5 to 10% increase, depending upon the product. If you have higher gross margins, 10 toward the 5%. So it depends upon the product, but this is really a smart financial decision. And most founders are not educated enough on finances to make that decision. So now you are, so make it. All right, the next way that we can help with some cash flow is Shopify Plus. If you're a larger brand and you're on Shopify Plus, you can get net 30 terms with them. They'll negotiate it. It's pretty simple, actually. You probably just have to ask. But they'll give you net 30 terms on Shopify Plus, which can help for a few $1,000s per month cash flow. And the last one for suppliers, and this is like a recent company that I found, it's called Portless. And I don't have an affiliate link with them. I probably should, but they're a 3PL that will essentially ship from China direct to consumer in 7 days via USPS Air with no China tracking number. So the companies like Temu that are out there that are shipping from China really cheap, right? They're essentially doing this, but this is a company that you can use for your own inventory. And the benefit is now you can order inventory by minimum order quantity as opposed to container size, since all your products are going to be shipped individually via air to the US. So this can cut your inventory buys substantially, like 50% decrease in inventory we've seen. And the second big benefit to going with Portless, and I have a feeling there's going to be a few of these companies popping up, but this is the company right now, is that you can ship internationally now direct from China in around 6 days, and you don't need a local 3PL, right? So you immediately open up international access going through Portless. So great value proposition. Good job, guys. All right, let's talk about how our customers can fund our business. So we want to launch some sort of email pre-order list or some sort of like crowdfunder type thing on our site. So we want to launch as many products as we can so we can collect revenue. We want to pre-launch as many products as we can so we can collect revenue before actually launching the product. Now, most people will make a pre-order list and then they're going to hype that up. But you're actually not collecting revenue until the date of the launch, right? So what we want to do is we want to allow them to pre-purchase the product on our site 30 days prior, net 30, so that we're collecting funds 30 days before launch, which helps to increase cash flow in the business. Now there's a SaaS Shopify app called Crowdfunder that's pretty cool. Let's see what happens if I click this, how bad this is going to be. Okay. So essentially, here we go. What Crowdfunder is going to do is Crowdfunder is almost like a Kickstarter on your website. So it's not Kickstarter, it's not Indiegogo, goes on your website. It's kind of like a product page. And you can kind of see here that it'll show how many people are supporting you. It'll show how much has been raised. There's a countdown timer. But the important thing is this will allow you to collect funds prior to launch. right? So before you even launch it, now we're cash flowing. You can do this in longer periods of time too. Like you could do this 60 to 90 days out if you want. The risk to that though is your merchant processor. If you're using Shopify payments, it's white labeled Stripe. Shopify payments is a low risk merchant processor. And if they see that you have transactions that are 60 and 90 days out without a shipment attached to it, you might get in some trouble, right? So extend that at your own peril, right? But it is possible to do that and extend some cash flow there too. Okay, cool. So that's how we try to get some cash flow from our customers. Now let's talk about ad platforms. So all the big ad platforms have what's called monthly invoicing. And this is essentially net 30 terms for each of the platforms. So for instance, if you have ad spend between October 1st and October 31st, you wouldn't have to pay until the end of November, right? So 30 days additional cash flow, which is huge. Facebook has this. Facebook will actually give you net 30 terms, and then they have a grace period afterwards that's 15 days. So you could go net 40, technically 43 if you wanted to with Facebook, and they're not going to boot you off or kick you off or anything. So if you need it, it's there, just so you know. If you have a big order for Christmas, this might help. It's becoming increasingly more difficult to get monthly invoicing without a Facebook rep. You pretty much need one. I've seen like 1 or 2 cases where people have gotten one without one somehow. But you basically need a Facebook rep now to get this. So anytime you have a Facebook rep reach out to you, they're annoying, but at least answer their phone calls or answer their emails and see if you can get monthly invoicing if you don't have it. Google will give out monthly invoicing very easy, at 30 days. Same thing for TikTok. Very easy to get, both Google and TikTok. And once you have this presentation, there's links that are live and will take you to exactly where you need to go to apply for it. And it's a very simple process. All right, let's talk about a cool banking platform. So there's this company called HighBeam. They're a banking platform. And what I like about them is 2 things. Number one, they have an instant deposit feature that's going to make Shopify funds available the same day, right? So there's typically a couple day delay between when you sell something and when those funds are deposited into your bank account. And HighBeam will actually do instant deposit, so it'll make those funds available same day. So you might get a couple days extra cash flow by switching to HighBeam, which is pretty cool. The second thing that I really like about them is as of today, and this is subject to interest rate changes, obviously, but they have around a 4% APY on any bank deposits. So if you got $100,000 with them, they'll give you $4,000 at the monthly by the end of the year, which is pretty cool. All right, credit cards. I'm going to talk about these, and then I'm going to talk about why I think they're the right thing to do versus a points card. So there's 3 main business credit cards that I'd recommend that underwrite your business that are net 60 terms. And that's Row, Parker, and Ampla just released one last month as well. So there's a couple players in here. And I expect this list to grow. Row will give you actual net 60 terms. Parker and Ampla do what's called rolling net 60. So depending upon when you purchase an item, it might come due on day 31. Or might come due on day 60. You have to kind of time things out there. These guys will actually underwrite your business, right? They're going to take a look at your QuickBooks or wherever you store your financial data. They're going to take a look at your Shopify. They're going to take a look at your ads, and they're going to actually underwrite your business. So you need some sort of cash in the bank. They want some sort of minimum revenue amount, maybe $1.5 million to $1 million, depending upon which one of these guys you go with. But they will give you a decent amount of cash. You can get credit lines up to $10 million with Parker. Usually 40–80% of monthly revenue, which could be a substantial help, right? And this again, like no interest attached to this unless you're late in it, I guess. So these are the traditional e-commerce net 60 cards now. Amex Plum, I kind of separate. Amex Plum is a net 60 card, but Amex Plum doesn't underwrite your business per se. They're going to underwrite your personal credit history. So they're going to take a look at your personal credit score. Just like all the Amex products, if you have an Amex Platinum or an Amex Gold they use, they underwrite using your personal credit history, and then they give you some amount based on that, right? So these guys are going to really look at your business. Amex Plum is going to look at your personal credit history. This could be better or worse for you, depending upon your business or depending upon your personal credit history. But this is an option. Bit of an asterisk here is that we've seen some instances with clients where they have had an Amex Plum card after they'd had an Amex Platinum card, and Amex ended up capping them for both cards. So Amex Platinum is a charge card. You theoretically have a unlimited max, even though it's not technically true. But we've seen some people hit a limit after they have an Amex Plum on top of an Amex Platinum or an Amex Gold because of the additional risk here, right? Because now Amex is looking at you and saying, okay, now not only do I have 30 days of risk, but I have 60 days of risk. So you could end up being capped here, but this is a really good option if you don't have the ability to use something else up here. All right, controversial part of this. And I had this conversation a lot with people. So the question is, why would I not have my points card that gives me 2% cash back per month? And why should I then instead use a net 60 card? And this is my argument. And it's going to be valid in some circumstances and less valid in others. If we take a look at a brand that's spending $100,000 a month, they're going to get 2% cash back per month, let's call it, right? Over a 12-month period. So over 12 months, month one, they're going to get $2,000, month two, $2,000, right? So they get $24,000 over the course of a year, if you do the math, right? $2,000 times 12 months, $24,000. So you have a 24% interest rate, essentially, or hurdle rate that you're trying to beat there. Meaning, if you can find something that's going to get you more than 24%, you should probably do that other thing. And this is my question that I would ask you. So that same business that's making $100,000, or spending $100,000 a month and getting $2,000 per month back, if you're spending $100,000 a month, if instead of giving you $2,000 over 12 months, I just gave you another $100,000, how much could you make on that money? What could you invest in terms of people or assets or companies, whatever that is? What could you make on that funds? Ads, right? Inventory, whatever it is you're going to invest in. Could you make more than 24%? And the answer to most high growth DTC brands is yes. You can make a lot more than 24%. You could make 50%. You could make 70%, whatever that percentage is, right? So if the answer to that is yes, then you should do it, right? Now, the drawback, right? Obviously, the Amex points are guaranteed. They're risk-free, essentially. So it is a risk. But again, if you're a very high growth D2C brand, I think the cash flow makes sense in most circumstances. All right, hopefully you're sold. If not, that's okay, I still love you. All right, we'll talk about lines of credit next. So give me one second. All right, so e-commerce brands are what are called asset-light brands to the banking industry. The banking industry is very risk averse. They like to have collateral for things. So there's not a lot of banks out there that will fund e-commerce brands. Again, they're asset light. If you default on this line of credit, there's not much that they can take or collateralize in terms of risk. If you're a traditional business, you might have some sort of real estate that they can collateralize. You might have a lot of machinery they can collateralize. You might have other things they can collateralize. But an e-commerce brand, you have a little bit of inventory, right? So for them, they view you as high risk. That being said, there are a handful of vendors out there that will do lines of credit for e-commerce brands. The biggest one is Ampla. So Ampla, you need a decent amount of runway. So you need to be decently funded. You can be bootstrapped, but you need to have some cash in the bank because they're really going to underwrite you. The nice part about that is there's no revenue minimum and there's no personal guarantee. They will give you a decent-ish, to good APR, anywhere from a 9 to 17% APR and a 3 to 5 month term. But they will fund a lot, right? They'll fund 1 to 2 times your monthly revenue. These interest rates, all this is subject to change with the interest rate environment we have right now. But at the time of this is where it's at. But if you got some funds in the bank and you're looking for extra cash, Ampla, good opportunity. Local banks and credit unions, again, very risk averse. Don't typically like to lend to e-commerce brands that are asset light. We have seen this with some, I call them more legacy e-commerce brands that we invest in or that we partner with. They're typically like 8 to 10 years old, have great EBITDA history, clean financials, like there's no sketchy things in there, no questionable things in there. Banks and credit unions might be more willing to lend to those type of companies. And usually as a minimum at all, you need like 3+ years of business history, you need healthy financials. Local banks are going to be higher interest rates typically than a credit union. Larger banks are going to be even higher interest rates than a local bank. So that's kind of the order I'd look in. I'd say, what's the credit union that's around me that I probably already want to have a relationship with? Because the interest rate in term they're going to give me is probably going to be better than a local bank, which is probably going to be better than a larger bank. And that's just a function of risk tolerance, right? The local bank, they care more about the people, they care less about making a big deal. And they're also nonprofits, right? Same thing for local banks. Underwriting is done at the local level. Typically, they're going to be more accepting of an e-commerce brand than say like a Bank of America or Chase. Even though you can get credit lines at those places, it's just rarer, I would say. All right, Amex, they started doing lines of credit again recently. They turned them off for a couple of years post-COVID, during COVID. But now you can get a line of credit through them. And they're actually not really bad terms. They're 6, 12, 18-month terms. And you can get them anywhere from a 6 to 18% APR. Now, like the other Amex product I talked about, Plum, or like any other Amex product you use, there's a PG, personal guarantee, required here. So if you default, you're on the hook, right? But these are actually pretty decent terms for the money right now. And then lastly, there's High Beam. They're kind of a newer entrant to the market. They are the banking platform that I told you about earlier, but they will give you a decent amount of cash. They'll give you 50 to 100% of your monthly revenue. The cost is not terribly cheap, 14 to 70% APR as of right now. But this is actually a large amount of cash, right? This could be a game changer in terms of cash flow for a lot of the businesses here, whose alternative might be something that we would talk about later with a much higher interest rate. All right, so that's lines of credit. Now, let's talk about invoice financing. These are kind of newer. And what they'll do is they'll finance any invoice up to net 120 terms. So if you have like an invoice from your manufacturer that typically they will only accept a wire on, like these invoice financing companies could help you on that. A Facebook payment, like these could help you on that as well. And there's kind of two categories that I want to separate here. And the first one is what Settle and Ramp do. And Ramp has a lot of different products. The product you want is called Flex for invoice financing. And both of these products will give you anywhere from net 90 to net 120 terms. And what they do is they will extend payments 1.5 to 2.5% for every 30 days net. So if you have a Facebook invoice that's due and you say, I can't pay this right now, or by hopefully better, like I don't want to pay this right now because the cash is worth more to me in other places. You can say, hey, Settle, can you extend this payment by 30 days or 60 days or however many days? And in exchange, I'll pay you 1.5 to 2.5% for every 30 days, right? So if you annualize this, this is like a 17.5 to a 30% interest rate. And this is based on their underwriting. They're going to actually underwrite your business because they're extending you essentially another line of credit, but for invoices. You need some cash in the bank because of that, right? If you're going under, they're not going to give you this because you're probably not going to pay them back. So this is the first section of this, I'd say, invoice financing. This is really valuable for Facebook ads or for any sort of ads, really valuable for inventory as well. If you can't get that net 90 terms with your supplier, like this would be my next go-to to try to get those terms artificially, not through the supplier, but through a third party. There's another cool software here called Melio. And Melio is now also Shopify direct bill. Shopify white labeled Melio, just like Shopify white labeled Stripe for Shopify payments. And what Melio does is Melio and now Shopify direct bill will transfer any wire to your credit card for 2.5 to 2.9%. And this is based on negotiation and your credit history with them, et cetera. Why this is really cool is you can now wire to a net 30 or net 60 card. So if you have something from your manufacturer that's due an invoice, or if you have a Facebook bill that's due, you can say, Melio, throw this on my net 60 card, right? Effectively, what you've done if you do that is now you've extended, you've cut in half the interest rate of this, right? Since this is 60 days to pay back as opposed to 30, you effectively cut this interest rate in half to like 1.25% per month, and then call it like 1.5% per month. So that's easier to digest, right? That's like a 15% interest rate to maybe 18% interest rate, annual interest rate, right? So that's pretty cool. Then there's asset-based lending. And this is what's traditionally known as inventory financing. And these companies will loan 50 to 60% of inventory costs at a reasonable interest rate. So say you have $1 million in cost, inventory cost, they'll say, hey, I'll give you $500,000, we'll give you $500,000 at a 8 to 15% interest rate. Now, that money is going to be collateralized to the asset. So if you default, they're going to take it and try to sell it so they can de-risk it, right? So there's some risk there. But this is actually not terrible in terms of effective interest rate. There's three main players out there. There's probably a couple more, but there's three main players out there that I want to mention. Assemble Brands, Dwight Funding, and Rosenthal. Each of them handles funds differently. And I think this is a really important point to understand. So I'm going to walk you through what they do. So Rosenthal, what Rosenthal will do is they'll give you the money, and then say they give you $500,000. They'll give you the $500,000, and then let's say any new funds that are deposited into your bank account from Shopify or whoever you're selling through, we're going to take 100% of that money until you pay us back, right? So they're going to give you the money, but they're going to take every money, all the money that's coming into your bank account after they give you the money until you pay them back. So I don't like this because it doesn't give you the cash flow addition on top of what's in your bank account. It just kind of gives you some funds and then expects you to pay it back. This is called a sweep. So I don't really like Rosenthal for that reason, but if you need some cash, you potentially go with them. Dwight Funding does something that's very similar. They have what's called a lockbox. So instead of using your own bank account to take money out of, they'll say, hey, we have a whole new bank account for you. You're going to direct all funds, all Shopify funds into this lockbox. And then until you pay us back, we're going to hold all the money. Again, doesn't really help you that much from a cash flow perspective because you have to pay that back. Assemble Brands is, in my opinion, a better route because they don't have a lockbox. They don't have a sweep. The interest rate will be higher because this is riskier for Assemble Brands, but I think it's worth an extra point or two to be able to have the extra cash flow. Remember, your number one most important financial KPI, to have that extra cash flow in your bank, right? Now, again, these will all underwrite your business. You need to have some sort of minimum annual revenue, typically like right around $3 million. And you also need a minimum amount of inventory costs, which is typically around $500,000 to $1 million. But this could be a viable route if you're looking for cash and have a bunch of inventory lying around. All right, purchase order financing or PO financing. What these guys will do is they will finance purchase orders for new inventory. It's very expensive though. But if you don't have any inventory and you say, I need to buy more inventory, they'll help you buy it. It is a very expensive cost of capital. And I've seen instances of up to 70% APR, which is crazy, right? And the devil is always in the details here. And I'll tell you how the devil is in the details with purchase order financing, and then also with revenue-based financing, which we're going to talk about next. This is how this will typically look. They will say, I will give you $100,000, and in exchange, I want $115,000. And then you do the math on that, and you say, oh, that's $15,000. That's a 15% interest rate. But what they don't tell you is the average payback period might be 3 months. So what you have now is you have a 15% interest rate over a 3-month period. You need to annualize that to come up with your APR, and your APR is essentially your annual interest rate. So if you take 15%, which is for 3 months, there's 4 quarters in a year. So 15 times 4 is 60%. So that 15% interest rate actually is 60% interest rate. It's a very, very expensive cost of capital, right? And that's why the devil is in the details. You have to really run the numbers to see where they're at because it seems like a good deal, but it's not. And there's a heuristic there. And the heuristic is the cheaper and easier, or the easier that money is to get, the worse that it is for you. The easier money is to get, the worse that it is for you. And that's because they don't actually really underwrite you, right? They will give money out to anybody that has an EIN because they're making so much money on that interest rate. It's essentially like you're taking money from the mob, right? You could probably actually get cheaper money from the mob. But this is legalized mob. All right, so there's 2 main PO financing companies. There's a lot of these, right? But I'll just talk about kind of the two ones that have the biggest marketing budgets anyway. And that's Wayflyer and Kick Further. Again, these kind of are lenders of last resort. Devil's in the detail here. What also might happen in these situations with PO financing companies is they might give you a good interest rate, but then they might charge you some sort of platform fee on top of that as well. So now you have to add that in to the APR to figure out what the actual effective interest rate is. And often it is not very good, right? So you got to look for all the hidden fees and all the ways that they kind of trick you in there. Revenue-based financing is very similar. Very high interest rates, devil is in the details. And these are what most people will default to that are newer to e-commerce, that don't really understand finance. But they'll finance based on your company revenue, right? So if you have company revenue, they will give you money. And you're going to pay them back every single deposit that you get as well. 10, 15, 20% of your deposits, you're going to pay back to them. And that would be like a Shopify Capital or a Clearco. Again, they will give out money to anybody that has an EIN and revenue, right? And this is very easy to get, very bad for the business. And we've seen a lot of instances where brands have come to us, they've had a Shopify Capital loan, they have a Wayflyer loan or a Kick Further loan. Very difficult to get out of that because the cost of capital is so high. Very expensive. All right, I just walked you through a lot. These are all the cash flow options, the main ones anyway, do you have as a D2C brand. And we started with the least risky options. And these are where you're going to want to attack first, again, like suppliers, ad platforms, a banking platform, credit cards. Like these are very easy to get and very low risk. And then we ended with the highest risk options. And these are your lenders of last resort. Inventory financing, PO financing, revenue-based financing. These are for situations where you may be starting off, there's no other capital source that you have, or your company is not in a good financial situation, and this is the only thing that you can do. But this will exacerbate the issue because the interest rates are so high. So I hope you enjoy this presentation. Let me know. Thank you for your time.